Is Realty Income still a strong undervalued buy now after some more bad news? Now, this is a REIT that is down more than 12% over the last 12 months. It is also down more than 20% over the last 5 years. However, we do see 3 strong buy signals from Seeking Alpha and Wall Street, as well as quant analysts. And in fact, it is one I hold in my own portfolio. So we're going to do a deep dive to understand what is going on with Realty Income and if we should continue to add. We are going to take a look at some new insider movement. Now, we have some insider selling that we have noted just over the last few weeks. As always, we will take a look at institutions to see if they continue to buy and sell. But we also want to take an update on the look of what the Fed will do with the interest rate. And we are going to touch upon how that will have a massive impact on this company. Now, we'll also do an update on the valuation. We want to get to the intrinsic value as well as our acceptable buy price given our investor margin of safety, and we'll talk about Wall Street to see what they see as the share price over the next 12 months for this REIT. When we take a look at the S&P 500 year to date, we do see a lot of mixed results. We see some companies that are up significantly double digits. However, we also see some that have performed very, very weak just year to date. Now, today's episode, we are focusing on Realty Income, but what we do note, the REIT industry as a whole has performed very poorly. The majority of them are down, in fact, double digits. We do see 1 or 2, however, that have turned positive. So we want to understand what is going on with the REIT industry as well as Realty Income. Now, firstly, when we do take a look at this company, we do see even over the last 10 years, if you have been essentially investing, you would be up 28%. Now, it doesn't include those monthly dividends reinvested. It would be slightly higher. And we do also note it has fallen dramatically from 2020, that pre-COVID, that pandemic era, where it was sitting at just under $80. Now, currently, it does trade in the midpoint of the 52-week range. It does also have a forward yield of 5.74%. And don't forget, this is a monthly dividend-paying company. So let's take a look at this company. Let's run through a lot of the numbers. Firstly, we just want to have a brief reminder as they are due to report their earnings over the next 2 weeks. In terms of their top line revenue, we do want to see 5 to 10% growth for REITs in particular. It's gone from 934 million to around 4.1 billion. And when we take a look, we can in fact see over the longer term it is growing, which is very strong. In fact, it's grown more than 4 times over the last 10 years. We also want to ensure that the bottom line is also growing, and we can note that their net income has gone from 271 million to around 872. So very strong, as we can see, more than double, slightly lower than the rate of the increase on the top line. And we can in fact see the last 2 years have been very strong for Realty Income, although we do note, in fact, before that, the growth period was very small. Now, when we move on to the balance sheet, as always, very important to understand the health of these REITs, their cash versus their total debt. They had around 4 million in cash in 2014, 233 million from that latest quarterly report. We do note, though, it is fairly inconsistent year on year. It does move quite largely. Now, when we take a look at the essential debt, numerically and directionally, what we do note, it has gone from around 4.9 billion to just over 22 billion. So their cash has moved very minimally whilst their debt has increased quite significantly. Now, this is typical of REITs, so it is no surprise, but it does mean when we look at that dividend safety later on, we do need to understand and ensure that this is one where that dividend can continue to be paid. And we will look at the metrics as well as the dividend safety as part of our analysis today. Now, we also want to take a look at few underlying metrics. The first one is their growth grade. Now, positive to note, they did in fact get the best grade obtainable with an A+ rating. When we look at a few of these numbers, the first one we can look at is their historical adjusted funds from operation growth. Over the last 5 years, it has been growing at 4.63%. We can see this is significantly higher than the sector median of 2.27. And on a forward basis, they are projecting around 3.16. Again, sector median coming in at 1.62. So that is very positive. And also, very importantly, both operating cash flow growth on a year-on-year basis, as we can see, double digits versus 5%, and on a forward-looking basis is a lot stronger than the sector median. So in terms of growth, this is a very strong REIT, A+ rating, the best score obtainable. When we take a look at the profitability, whilst we don't have an A+ rating, we still have an A rating, which is very strong. Now, a few reasons for this. So the adjusted funds from operation, although we will cover it later, does show us about the dividend safety, 75%, with the sector median coming in slightly lower. And as well, when we do take a look at the adjusted funds from operations over the total revenue, we also see some very strong percentages, significantly higher than the sector median. Now, there are other metrics if you do want to see, notably the cash from operations, but overall we can see both on a growth and profitability, this is a very strong REIT, one of the best out there. Now, what I also quite like to do from time to time is to check how they're performing versus others in the retail REIT industry. We have Simon Property Group, Kimco Realty, Regency, and a few others. Now, we have also reviewed these in depth on our channel, so do check those out as well. Over the last 12 months, we do note reinvesting those dividends, you would still be down -7%, and they are the worst performing in this space. When we expand it over the last 5 years, they are in fact still down. Though they may not be the worst performing, they are down 1%. So over the last 5 years, not really a great investment, although again, hindsight is a lovely thing. Over the last 10 years, interestingly to note, they have gone from the worst performing over the last 12 months and the last 5 years to the best performing over the longer term with 100.79% growth. Now, what I would say is bear in mind that past performance is not an indicator for future performance, but we can see when you do zoom out, Realty Income over the longer term has performed fairly well. And remember, this is a monthly dividend paying company, so different investors will have different reasons and goals as to why they invest in REITs and monthly paying companies. So let's take a look at the few things we wanted to discuss specifically in today's episode. The first one is insider ownership. Now, that does currently sit at 0.1%, and what we have noted is one selling over the last 12 months, 470,000. Now, what we wanted to discuss today is that in Q2, so essentially this quarter, not even that long ago, we note 271,000 worth of sales. When we take a look, and this is something that is new, so it is updated from when we did last review Realty Income, we can see here on the 9th of April that Larry Chapman, one of the directors, continued to sell more. As we can see, he did in fact sell on the 18th of December. So in total, over the last few months, he has sold 5,000 plus the 3.5 that he sold in the back end of 2023. Now, it is a total of 271,000, and whilst we don't believe that a director selling is essentially a bearish signal because they could sell for personal financial reasons, it is something we did want to draw to your attention, as a lot of investors and in the community will include this into their own investment thesis as well as into their margin of safety that we will discuss later when we do take a look at the valuation. Now, how about the institutional ownership? So we do see that just over 70%. We see 1.3 billion worth of sales. We see a lot more buying by the institutions over the last 12 months. And what we also know now with the full data set of Q1, we can see that institutions have in fact from January to March been buying a lot more than they have been selling, 216 versus 48 million. And we also want to remind you again, do not invest purely on what institutions or insiders do. Always do your own due diligence, but as we like to do, we do want to incorporate this into our overall investment thesis, as you can see in today's episode. So let's move on now to a few other discussion points. Now, the first one is going to be talking about the Fed keeping the rates. As we can see, the article here from a few days ago does say that it may not be such a bad thing. Now, this isn't something that they are talking specifically about the REIT, so the real estate investment trust sector, but it is something overall that they do discuss, and we're about to come into some predictions. What the article talks about, how it is essentially tough to say that these higher interest rates that we currently have in the US is having a negative impact on the economy. Therefore, right now, there is no real reason needed to start cutting those rates. And we can see here the economy does look to be performing well, and so does the stock market, especially over the last few months. As we can see, when we did take a look at the S&P map, the majority of those stronger stocks are performing fairly well, and therefore it will be tough to sell the case to the Federal Reserves that these higher interest rates need to be cut as soon as possible. Now, what does that mean for predictions over the next few months? Well, what we can see here from an article from the New York Times, this was a fairly recent one, and this looks at the expectations of when the rates will be cut. 3 months ago, they did expect by the end of the year we would be sitting at around 4%, whilst currently it is around the 5.5%. Now, what they have noted over the last month, they also see that predictions has started to anticipate there will be less cuts, with the latest forecast expecting there will be one at a maximum two by the end of 2024. So as time has progressed in 2024, the expectation of rate cuts is getting smaller and smaller, and it will be interesting to see at their latest meeting next week whether or not we will have any more information about what they're expecting to do in the shorter term. Now, why is this something that is closely linked with real estate investment trusts, which is what we are discussing today? Well, as we have shown before, when they do end their tightening cycles and they do start to cut, as we can see in the blue, the public real estate sector does tend to outperform quarter on quarter those of the equity market. So we are essentially anticipating that when they do start to cut, companies like Realty Income will outperform others in the equity space. Now, one thing that we also want to point out is even though essentially the market isn't factoring massive amounts of cuts right now, it isn't a massive worry for Realty Income, although this again is my opinion from the debt summary that we have. The main reason for this is that they hold 94.3% of their total debt, as we can see, 20.9 million in fixed rate. Now, fixed rate, what rate exactly is that? Well, we can see on average, so this is the weighted average, it does sit around 3.89%, which is significantly lower than the 5.5 that we are seeing today. As we can see, the weighted average is around 5.9 years, so there is still quite some time before Realty Income will need to revisit their fixed debt, which again is a very large portion. So in my opinion, right now, even though the price may be in a decline or has dropped massively, that doesn't reflect Realty Income's position as well as their dividend safety and their overall business, as we are about to find out. Now, just to let you know as well, we have released our free weekly article. If you do want to gain access to this or any other articles, it is completely free. All you need to do is click on the pinned comment below. And we do get a lot of questions by the community asking what websites we use. Well, in one of our articles, we have gone through all the resources we use and discuss on our YouTube channel. So do go read that if you are interested. Now, finally, before we look at the dividend safety and the valuation, we just wanted to point out with a REIT like Realty Income, what sort of benefits you are getting as a shareholder, bearing in mind that this is a monthly payer. Firstly, you are getting between a 4 to 5% yield over the longer term on average. Right now, it is sitting near that 6% level, but overall, you can see 4 to 5% plus a 4 to 5% adjusted funds from operation per share growth, and the overall operational return does sit around the 8 to 10%, which is fairly strong, as we can see here. When you do look over the longer term as well, Realty Income's cumulative TOR, so that is the total operational return, does sit marginally lower than the S&P 500, and a lot of people who do use that monthly dividends for their own expenses may actually be happy with only a few percentage points less than the S&P. Now let's take a look at that dividend safety. It does still sit at 80, so it does look to be safe. We also want to point out that the dividend safety has also been reaffirmed just a few weeks ago. In fact, we can see that on the 6th of March, the safe rating was reaffirmed following their latest earnings release, and therefore they do believe that a dividend cut is unlikely, which is positive to note, but not surprising given all of the essential analysis that we have been doing. Key metrics, well, the last recession, they did increase the dividend during the 07-09 crash. They had above average growth, so negative 0.8% versus the S&P's negative 12, and they also outperformed the S&P, negative 43, with the S&P coming in at negative 55. Now, dividend growth for this company is 3% over the last full year, 3% over the last 5 years, and 5% over the last 20. Remember, on this channel, we do advocate a minimum of 4% just to keep up in with inflation, as the US inflation rate over the last 40 years was 4%. Anything less, whether it's your dividends, your salary, or other income-producing assets, you are in fact getting a dividend cut and losing your purchasing power. So something just to note with these increases year on year. Now, they are also a dividend aristocrat. They have increased those dividends for 25 years or more, and we can see they have been paying a dividend for the last 55 without a reduction. Now, for newer viewers, essentially, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average, so we have a massive undervaluation signal. Bear in mind, though, we don't look at any of these models in isolation and will conclude towards the end. We also see the forward P to AFFO ratio, 12.9, much lower than the 5-year average as well. And also we see it marginally lower than real estate sector P to AFFO at 13.6. As always, whilst we do like to draw your attention to the free cash flow for REITs, it is a lot more volatile. So we look at the adjusted FFO, the funds from operation. And as we discussed earlier, it does look fairly strong because for the majority of REITs, we want to see below 90%. For Realty Income, 76 in 2023, 74 expected in FY24. So no real worries with the dividend based on this information so far. Then when we take a look at the adjusted funds from operation per share, what you always want to see is this increasing year on year. $4 in 2023, we can see the increases that are consistent. 2024, they are expecting $4.17, so that will be positive to note as we do hope the synergies with the acquisition of Spirit Realty will come into fruition. When we take a look as well, percentage-wise, we can see it is a little bit mixed. Some years low single digit, some years high single digit. But as we did take a look at the presentation earlier on, this is expected to be around 4 to 5% on average, giving them that 8 to 10% operational return. When we move on to the sales growth, whilst we analyze it, we can now clearly see the percentages very strong, more than 5 to 10% that we see on a consistent basis. Last 3 years looking very strong as well, and therefore just another format to see their sales. We can see some very strong growth over the longer term. For the majority of companies, we want to see a lot of share buybacks with decreasing shares outstanding. With REITs, however, it is very typical that we see this, where essentially they are diluting your position as a shareholder over the longer term. Main reason for this is they don't hold a lot of that internally generated cash flow as they do pay it out as dividends. So for them to continue to grow, as we can see, they have to continually dilute. So just something to factor into your own investment thesis as well. ROIC, one of my 7 golden dividend metrics, I want to see around 3 to 5% as a minimum for REITs. We do see that right there in 2022, 2023. Something to keep an eye on, but I would like to see them back to the levels we have seen from 2014 to 2020. Now, operating margin, it does look very strong in the mid-40s, as we can see. 2023 at 42%. Again, it would be nice to see some operational efficiency and see these numbers increase over the longer term. Something, again, just to keep an eye on. Finally, something that does correlate to both dividend safety as well as balance sheet strength is the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. For REITs, it is imperative we see below 5.5, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. It has been pretty much straddling above that level year on year, so not the greatest. The one thing I love to see is that FY24 it is expected to come down significantly to 4.67. So if this does come down and it does come into fruition, then next quarter or next year's annual reports, when we revisit this, hopefully we will see that dividend safety go up to around 90-95. So let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button. And as always, let us know your thoughts in the comments below as we go along. Now for REITs, typically we wouldn't use Graham's valuation due to the fact that it isn't relevant for real estate investment trusts. So the first model we are using today is the multiple valuation model. We have those companies in the similar sector, the retail REITs. We have their P to AFFO multiple as well as the average, as well as that of Realty Income to give us an intrinsic value on today's episode of $64. And we can see our first undervaluation signal. Again, bear in mind we don't look at any of these models in singularity. We then move on to the dividend discount. Now we can see the increases over the longer term at around 3.14%. So forward looking, we've estimated marginally higher at 3.25. This gives us an intrinsic value of $67. Again, our second signal of severe undervaluation. We then move on to the DCF model where we have the free cash flow year on year, around 20% growth as we can see. We've gone a lot more conservative at 6%, which is also lower than the last year increase. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, our third and final undervaluation signal. Now, the intrinsic value in today's episode is just the average of these three models, coming to a total of $65.78. As always, you can grab a copy of this valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, as well as those on your watch list, by clicking on the pinned comment below. So a margin of safety, now remember at 10% we execute if we believe it meets 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. So right now a 10% MOS level would be a buy up to $59, and then we keep going till it's near the current trading price. And in today's episode we can see it doesn't quite hit the 20% MOS level just yet, so it sits between 15 to 20%. Now, in terms of Wall Street, as we can see here, they expect a price of just under $60 over the next 12 months. They see upside of 12%, and as we saw at the beginning of the episode, Wall Street, alongside the other two analysts, do believe that this is a buy now. Now, this, in summary, is one that I also hold as well. However, right now, I will just be holding to this position as I was buying when it did have a much larger margin of safety. So for those who are looking, for example, at a 25% MOS level, you would be looking to buy around $49, at 30% around $46, which was towards the 52-week low. However, as we said in today's episode, it is around a 15 to 20% margin of safety. As always, though, do let us know your thoughts in the comments below. Does any of the news worry you with the insider selling, with the rates essentially not expected to be cut more than once, maybe twice over 2024? Or is this one that maybe is on the watch list or you don't want to touch for whatever reason? As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Let us know your thoughts in the comments below. And as always, we'll see you all on the next one.